Whenever investors say, "This stock will be my next Palantir," what they usually mean is not what they say. They do not usually mean the businesses are the same. They do not usually mean the customer base is the same, the product is the same, the economics are the same, or the competitive landscape is the same. What they mean is something much simpler and much more dangerous. They mean, "I think this could become one of those rare stocks that starts as a story, survives long enough to become a system, and then compounds far beyond what most people thought was reasonable." That is a serious claim, and it deserves a serious standard. I have never liked comparing one company to another simply because the stock chart of the first one created envy. Envy is a terrible research process. It makes people search for echoes instead of economics. It makes them fall in love with narrative before they have identified the machine underneath the narrative. And the machine is always what matters. So if we want to talk about whether SoFi has the potential to become one of those long-duration compounders people later describe with awe, we need to stop thinking in slogans and start thinking in structure. Not, "Is this the next Palantir?" That is a lazy question. The better question is this: is SoFi becoming the kind of business that can move from product provider to financial operating system for a growing share of its customers' economic lives? That is the real question. Because if the answer is yes, then the upside can be much larger than the average investor currently models. And if the answer is no, then all you have is a fast-growing fintech stock with a seductive story and the usual vulnerability to disappointment that all seductive stories carry. This is where I want to begin. Not with the stock, not with the app, not with some price target somebody posted because it sounded bold. I want to begin with the shape of the business. SoFi is not interesting because it offers one appealing product. It is interesting because it is trying to solve a harder and much more valuable problem. How do you get a customer not merely to borrow from you once, or invest through you once, or open a savings account with you once, but to gradually centralize more of his financial life inside the same ecosystem? That is a much bigger ambition. And bigger ambition, when paired with real execution, is often where the largest wealth outcomes begin. This is what many people miss. They still think of SoFi as a lender with a slick interface that is not wrong enough to be useless. But it is wrong enough to miss the real point. The most important businesses in finance are not the ones that sell one product brilliantly. They are the ones that become default behavior. Payroll lands there, savings grow there, borrowing happens there, investing happens there, cards are used there, advisory behavior gets nudged there. The user does not have to repeatedly choose the business in each category because the business has already made itself the operating layer across categories. That is what I mean by a financial operating system. And if a company gets even halfway there, the economics can become extraordinary. This is why banks are so powerful when they work well. This is why platforms are so powerful when they become habit. And this is why a company that can combine habit, trust, cross-sell, deposit funding, and low-cost distribution can become much more valuable than the market initially assigns. So let us look at the facts SoFi first. Quarter 2026 results were strong enough that even the skeptics need to admit the machine is becoming more substantial. In its official Q1 2026 earnings release, SoFi reported record GAAP net revenue of $1.1 billion, up 43% year over year, adjusted EBITDA of $339.9 million, up 62%, and its 10th consecutive quarter of GAAP profitability with net income of $166.7 million and diluted EPS of $0.12. It also added a record 1.055 million members in the quarter, bringing total members to 14.7 million, and total products reached nearly 22.2 million. Face site Fei turn 443,778 view 0 Fei. Those are not cosmetic numbers. Those are system building numbers. Why do I say that? Because the difference between a flashy company and a durable company is usually not raw growth alone. It is whether multiple parts of the machine are reinforcing each other. And SoFi's own language around the financial services productivity loop is worth taking seriously here. Not because management gave it a clever name, but because the underlying behavior is exactly what smart investors should care about. The more products a member uses, the more valuable the member often becomes, the more deposits stay inside the ecosystem. The cheaper funding becomes, the more flexibility the company has in lending and pricing, the more touch points the company has, the more chances it has to cross-sell. The more successful the cross-sell becomes, the more the customer relationship begins to resemble a platform rather than a single product. This is why I think many people are still underestimating what they are looking at. They keep staring at SoFi as if it were a one-line growth story. In reality, the company is trying to stack a set of economic relationships that can reinforce one another over many years. That is a much more interesting game. Now, of course, this sort of ambition is not enough by itself. Many companies talk a great game. Very few convert ambition into operating evidence. That is why the member and product data matter so much. SoFi is not just adding users, it is adding products per user and increasing the density of the relationship in the Q1 2026 release. Financial services products rose 40% year over year to 19.3 million. Lending products rose 33% to 2.8 million, and total product growth reached 1.8 million in a single quarter cross. Buoy also accelerated to 43%. That is exactly the kind of evidence you want if the core thesis is that the company is not merely attracting users, but deepening the ecosystem around them. FaySite, FayTurn 443,778 views 0 Fay. That is a very important distinction. A weak platform can add users and still create weak economics if users remain shallow, unprofitable, or one-product relationships. A stronger platform can become more valuable even before maximum scale arrives, because each new product inside the member relationship lowers the need to reacquire the same person through expensive external marketing. That is why product density matters so much. And this is where SoFi becomes genuinely interesting. The company is not just acquiring attention, it is trying to build habit. Habit is the real moat in consumer finance. People love to say brand matters, product matters, pricing matters, but habit is what makes the economics sticky. A customer who receives his paycheck into your ecosystem, keeps savings there, invests there, checks credit there, and borrows there is much harder to dislodge than a customer who simply downloaded your app because you offered a promotion last month. That is why I think the deposit story is so important. In the same official release, SoFi said total deposits grew $2.7 billion in Q1 to $40.2 billion, driven primarily by member deposits. It also stated that average total deposits made up over 90% of average total liabilities, and that the average rate paid on deposits was 155 basis points lower than warehouse facilities, translating into roughly $621.8 million of annualized interest expense savings from the remixing of its funding base. FaySite FayTurn 443,778 view 0 Fay. That sentence should make any serious investor pay attention, because now we are no longer talking only about a nice app or a popular brand or a growing member number. We are talking about funding economics, and funding economics are where banks, neobanks, lenders, and financial platforms get separated from one another. Cheap and durable funding is one of the quiet superpowers of finance. If you can fund your balance sheet through customer deposits rather than expensive wholesale channels, the whole business can breathe differently. Margins improve, pricing flexibility improves, strategic patience improves, and perhaps most importantly, the company gains a structural advantage that a pure middleman without deposits cannot easily fake. This is one reason I think SoFi is much more interesting now than it was years ago. Years ago, it was easier to tell a story about user growth and platform aspiration. Today, there is a more substantial argument. The company is not just aspiring to become integrated, it is becoming more integrated. This does not make it risk-free. Far from it. The first thing any serious investor must understand is that finance is never a gentle industry. Banks can make fools of people very quickly. Lenders can look wonderful until credit quality deteriorates. Platforms can look light and elegant until the cycle turns and the hidden balance sheet pressure becomes visible. That is why I do not want anyone buying SoFi because they heard the phrase, next Palantir and got intoxicated, that would be idiotic. You should buy or hold a company like this only if you understand the actual risk. And the actual risk is not some vague, what if it goes down? The actual risk is that finance is a confidence and underwriting business. If credit weakens meaningfully, if unemployment rises, if management misprices risk, if deposit growth slows, if competition intensifies, if regulation changes, or if investor patience evaporates during a harsher macro phase, then the stock can suffer badly. This is not a software company with nearly infinite gross margins and no balance sheet exposure. This is a financial machine. That means the upside can be very large if the machine gets built correctly. It also means that mistakes can become much more serious than in a simple subscription business. I want that said clearly because too many retail investors hear growth and forget the industry. Never forget the industry. Industry is destiny in ways the average chart watcher does not appreciate. Now, having said that, I do think the market still underestimates one part of the SoFi story, and that is the combination of youth, trust, and timing. A great many financial institutions are trying to figure out how to remain relevant to younger consumers whose financial lives will not look like their parents. Financial lives, branches matter less, category fragmentation matters more. People are used to switching apps, accounts, providers, and interfaces quickly. Trust is earned less by legacy and more by daily utility. This creates a strange opportunity. Incumbents still have scale and regulation and balance sheet depth, but they often do not have affection. And affection matters more than older generations want to admit. A customer who likes the interface, likes the messaging, likes the product bundling, likes the rewards, likes the one-stop design, and increasingly trusts the institution with more pieces of his financial life can become a multi-decade customer. That is where very large lifetime economics come from, not just from winning a loan, from winning a financial adulthood. That is the real prize. And if you win that prize early enough in the customer's life, the upside compounds. This is why I do not find the SoFi as just a lender critique. Very persuasive. It misses the customer life cycle dimension. If SoFi were merely pushing loans and nothing else, then yes, I would be much less interested. But the company's own product mix shows the opposite direction in the Q1 2026 release. SoFi Money reached 7.32 million products, Relay reached 7.32 million, SoFi Invest reached 3.67 million, credit card products reached over 436,000, and crypto products were back in the mix after the late 2025 relaunch. The product family is broadening, not narrowing. Faysight Fayturn 443,778 view 0 Fay. That matters because broadening gives management more levers. And in finance, optionality is beautiful. A company with multiple product lines can adapt its emphasis as conditions change. A company with one beautiful product is often one external shock away from discovering how fragile beauty can be. This is another reason I take the SoFi thesis more seriously than the average fast-growing fintech story. There is enough breadth now that the company can increasingly express different pieces of finance under one umbrella. Again, not risk-free, but much more powerful than a monocline story. Now let us talk about the part of the quarter that looked ugly, the technology platform segment. This is exactly the kind of area where lesser investors get lazy. They see weakness and either dismiss it completely because the main story sounds better, or they assume it ruins everything. Neither reaction is useful. In the Q1 2026 numbers, technology platform segment net revenue fell 27% year over year to $75.1 million, and enabled accounts were down 16% year over year to 132.9 million, largely because a large client had fully transitioned off the platform before year-end 2025. That is clearly not a strong set of headline numbers. But the same release also showed accounts rebounding by 4 million from the prior quarter, and management said it plans to launch a new unified brand, SoFi Technology Solutions. Across 4 platform businesses, Faysight Fayturn 443,778 view 0 Fay. This is what I mean by serious analysis. Weakness exists, but the weakness must be understood in context. If the decline were purely structural and accompanied by a collapsing strategic case, I would worry much more. If it is a temporarily uglier patch inside a business, the company is still trying to rebuild and reposition, then it becomes more of a show me over time issue than a thesis killer. This is also where SoFi differs from the overhyped stories of the past. The company does not need every segment to look beautiful every quarter for the larger thesis to remain intact. It needs the core machine to keep strengthening member growth, product density, deposit growth, funding advantage, cross-buoy, profitability so far. Those lines are moving the right way. Now, another thing I think many investors misunderstand is the role of profitability in a story like this. For years, the market let people dream about future scale without demanding present earnings. That period created great fortunes and great delusions. Today, the market is less forgiving. That is healthy. And it makes SoFi's current stage more interesting, not less. The company is not asking investors to imagine a distant future where one day it might become profitable if the stars align. It has already reached 10 consecutive quarters of GAAP profitability, according to its Q1 2026 release. That does not mean the company is mature. It means the company is demonstrating that growth and profits do not have to be enemies in this model. Faysite Fay turn 443,778 view 0 Fay. That is important. A stock can become a long duration compounder when the market stops viewing profitability as hypothetical and begins viewing it as a habit. Habits get valued differently. Hypotheses get doubted more easily. This is why I think the SoFi bull case is stronger now than when the stock was younger, more romantic, and less proven. The romantic phase is fun. The proving phase is what actually builds the investment case. Now let us ask the difficult question. Could this become a $50 stock in 5 years? Could it become a $100 stock over a longer horizon? Of course it could, but I dislike price targets when they are spoken to casually, because they hide the work required between now and then. To become one of those companies people later compare to a long-duration winner, SoFi must keep doing several things at once. It must keep member growth healthy without simply buying low-quality growth at any cost. It must keep deepening product adoption. It must keep deposits rising. It must keep underwriting sane. It must keep operating profit improving. It must navigate credit cycles without embarrassing itself. And it must continue proving that this is not merely a customer acquisition story, but a customer lifetime value story that is a lot, which is exactly why the upside can be large if it is achieved. People want giant upside without giant execution demands. That is not how the world works. The biggest stock winners often look obvious in retrospect only because they executed a very difficult list of tasks longer than most investors expected. SoFi could still fail that test. That possibility has to remain in the analysis. But if it passes that test, then yes, the market can re-rate it much more aggressively than the current skeptics think. Because once a company is seen as an emerging category winner inside a very large market, the conversation changes. It stops being, is this company real? It becomes, how big can this become if the ecosystem logic keeps compounding? That is the part the market eventually pays up for. And that is what people are really reaching for when they say something lazy like next Palantir. They are reaching for the possibility that the market is still underestimating how big the machine can become if it keeps winning the strategic layer of the relationship. Now, should you put your life savings into a business like this? Of course not. That is not courage. That is stupidity. The correct way to approach a stock like this is with proportionality. You treat it as a high upside but real risk position inside a broader portfolio. You do not turn it into your religion. You do not mortgage your future to prove your conviction. You let the business earn a larger weight over time through execution, not through your emotional attachment. That is how serious investors survive stories like this. They let the company prove itself quarter after quarter. If the machine keeps getting stronger, they stay involved. If the machine starts breaking, they reassess. But they never confuse admiration with obligation. I think that is especially important now because there is a tendency among growth stock investors to become intoxicated by the right numbers and then forget the larger discipline. The right discipline is simple: know the thesis, know the risks, know what would disprove the thesis, know what progress actually looks like, and then allow time to do its work. That is how you own a future compounder before the future becomes obvious. You do not need certainty. You need enough evidence that the company is moving from aspiration into structure. SoFi is closer to structure than many people realize. It is not just a hot app. It is not just a lender. It is not just a recovery trade. It is trying to become the default financial layer for a large, growing younger customer base. That is a serious ambition. And ambitions like that, if executed well enough, can produce very large investment outcomes. Not because somebody called it the next anything, because the company became itself. That is the whole point. You do not make real money by finding the next copy. You make real money by finding the business that can become one of the original winners of its own category. SoFi may still disappoint. It may still get hit hard in rough markets, but if it keeps stacking members, products, deposits, funding advantage, and profitability the way the recent data suggests, then the real question is no longer whether this is a neat fintech story. The real question becomes how much of young American financial life this company can own. That is a much bigger question, and much bigger questions are where much bigger stock outcomes usually begin.